Well, today I want to talk about bonds or fixed income yet again. Now, I do have some other videos out there on this topic. You can watch those videos if you follow these links right here. Now, in one of those videos, I talked about using the concept of modified duration to predict the change in a bond price given a change in interest rates. We found that it wasn't particularly accurate, especially as the change in interest rates grew. Now, today I want to introduce the concept of convexity and show how we can use that to further improve our prediction of the bond change given a change in interest rates. Now, to refresh your memory here, we're going to use this same exact bond here, right? So it's face value of $1,000, a coupon of 60, which means it gets a $30 payment every 6 months. If it's priced, or if it's the discount rate is 6%, then you'll see a price of $1,000 like you see here. We see the modified duration and we see the Macaulay duration also. Now, if we were to take this and kind of chart the prediction based on modified duration for the price of a bond given different interest rates, we're going to get a chart like this. So you're going to see the curved blue line is the actual price of the bond as we see these parallel shifts in interest rate changes. The orange line predicts where the price is, but you can see that as we go further and further away, as the interest rate changes more and more and more, then the prediction is worse and worse. But we can see that this looks a lot like something maybe some of us are familiar with. It looks a little bit like the tangent to a curve, and that is in fact exactly what we're getting here. Now, if you want to further go back, put on your calculus hat, think about a function x of t. You take the derivative of that, you get velocity. That's the tangent to the curve at that point, the slope of the curve. So that right here, that is in fact duration. Now, if we take the second derivative of that, we get acceleration, or here, and that is in fact what we get if we look at convexity. So you take the formula for a price of a bond, you take the first derivative of that, you're going to get the slope. That helps you kind of predict where bond prices might go given changes in interest rates. We can then take acceleration to get a sense of how that is moving from that tangent point. So again, these are the concepts we're talking about, but mathematically has a lot of basis there. Just I personally find that particularly interesting. Now, the actual formula convexity is this. Feel free to pause it if you need to. We're not going to go through the actual calculation. I'm just going to show you the numbers I came up with. So let's go ahead and look at that. So here we are. We have kind of the duration and everything like that. And if you go all the way over there, look at that formula all the way over to the far right column, you'll see this convexity number here, 21.77. So that's convexity. Now the question, of course, is what do we do with this number? Now, before we get there, let's go ahead and go back and look at the actual differences between the actual price of a bond given a change in interest rates and the prediction based on modified duration. And you can see if in the far right column, the error term there. So you can see that again, as we move away from that 6%, we get worse and worse predictions. Now, we're going to take that convexity number, we're going to plug it into this formula here, and that's going to be an additional adjustment to that modified duration prediction. All right, go over here. So we're going to do this. So I actually calculated this for you. Here are the actual numbers, this convexity adjustment. If you look there, look at 6%, you're going to see that, yeah, okay, there's no change in interest rates, but as we move away to 5.5 or 6.5%, you can see that the difference using just modified duration is 27 cents, and that convexity adjustment is perfect. But as we go out, the differences grow a little bit there. So if we go all the way out to a 0.5% interest rate, we're only the convexity adjustment isn't quite enough, right? It's only 32.92 dollars versus an actual difference of 36.68, but it is a lot closer than just using modified duration. In fact, if we look at a chart here, you can see that, yeah, it's really, really close until we get to those very, very tail ends there, making that prediction much, much better. But the question I've asked myself for years is why are we doing this? That was a lot of effort. We took derivatives and second derivatives, and we came up with a first adjustment and then a second adjustment, and it's still wrong, right? This still doesn't work exactly right, when it was actually easier to just build the spreadsheet and figure out what the exact price change would be. So it's still wrong. I don't get why people might even use this other than to think about it intellectually. I find that very interesting. The other thing is that all of this only works if every single maturity has the same parallel shift in interest rates, which is not how the world actually works. So there you are. That is convexity, and that is modified duration. I hope you like that. Happy trading out there. Thank you so much. I'm Brian Kozlowski.